So today's big idea comes courtesy of Goldman Sachs, and it's Goldman pondering what a world without share buybacks might actually look like. Specifically, it's Goldman's chief strategist, David Kostin, talking about this issue after the U.S. Senate introduced legislation that might, if it passes, effectively ban U.S.-listed companies from buying back their own shares. And this is a big deal for markets. People have been talking about this issue for many, many years now. There's this notion out there that maybe the huge bull market that we've seen in equity markets has been artificially inflated thanks to the corporate buybacks that we've seen. And on that note, Kostin comes out with some pretty big numbers here. He says basically for the past 9 years, net buybacks in the U.S. have totaled $420 billion annually, and that is compared to just $10 billion annually from mutual funds, household investors, and foreign investors. So actual investment flows there, Yusuf. Kostin is talking about what would happen if buybacks actually ended. He says essentially we might see lower EPS figures for companies. That would be relatively expected. But he also argues that you would see a lot more dispersion when it comes to returns in the market and a lot more volatility, right? Companies stepping in to buy their shares on the cheap after a big price fall has basically been supportive of valuations in recent times, and that's actually lent itself to a notion that during blackout periods, this is the period of time when companies cannot buy back their shares, usually 5 weeks or so ahead of announcing earnings, that when they stop doing that, that's when we tend to see some weakness in the market. And on that note, Kostin has actually crunched the numbers. He's gone back and looked at a bunch of buyback blackout periods and said that typically returns in the S&P 500 have been much lower during those periods than they have been for non-blackout periods. So some interesting numbers there.